My name is Geoff Howie. I'm the market strategist at Singapore Exchange. I've been in this role for a little over 10 years now, and my job is to explain and communicate to investors what's been happening in our very exciting stock market. So as a economist, I guess, and broker in the past, I really relish this role to be in touch with investors, not just in Singapore, but across the world, and share what's been happening really in the global stock market from the perspective of the very international and very efficient economy of Singapore. Well, I guess in the context of Singapore, which maintains a gross domestic product of 400 billion US dollars, we are a stock market that is very noticeable across the region. Obviously, we're very much entwined with the regional growth and development, but the Singapore economy is an advanced economy, and it is projected to grow, I think, by 3% this year. And our central bank, the Monetary Authority of Singapore, pursues a tighter monetary policy stance for over a year to dampen inflationary pressures. So we've very much been ahead of the curve in many of the present day themes and risks that are driving global economies and by consequence stock markets. So currently core inflation in Singapore is at 5%, and Singapore's target of monetary policy is actually a trade-weighted basket of currencies, and that's based on the reliance that this city-state really does have on imports and regional trade. So for the year to date, the US dollar has appreciated by just around 4% to the Singapore dollar, while the US dollar trade weighted index has actually gained 15%. So with that in mind, and that strong regulatory framework and very proactive economic policy making, the market capitalization of Singapore's stock market is within the vicinity of around 550 billion US dollars, which translates to around 800 billion Singapore dollars. The stock market benchmark is the Straits Times Index, which has been with us for over 50 years, and this year has actually been the most defensive advanced economy benchmark across the world. It has generated a flat total return versus a comparative decline of 25% for the FTSE Developed Index. Now, just as Singapore is a global financial hub, financial services are a crucial cornerstone for the Singapore stock market. We have a trio of banks, DBS, OCBC, and UOB, that make up 20% of our total market capitalization. It makes up 20% of the day-to-day turnover, the combined turnover of those three stocks. But at the same time, they contribute around 40% of the weighting of the Straits Times Index. And by comparison, banks represent some 5 to 10% of the global stock market. Now, this is interesting because that's the global picture. But regionally, when you look across Southeast Asia and the ASEAN indices, of which Thailand is also a part of, banks also make up the biggest sector of Southeast Asia, including Singapore, excluding Singapore. So banks are super important for this region. They are super important for the performance of our stock market. And the trio have outperformed the global peers, that's DBS, OCBC, and UOB, in all three timeframes of the 2022 year to date, of the period of time, which is 2 years and 10 months since the end of 2019, as well as over the 10-year period, the last 10 years. So that's a quick nutshell of, I guess, what a core strength or a core branding, I should say, of our stock market is here in Singapore. Well, the second one is the real estate investment trust market. And we similarly have a strong representation of real estate investment trusts like we do with banks. So globally, there's around 800 REITs listed across the world with $2 trillion US dollars of combined market cap. So that represents 2% of the global market capitalization. But in Singapore, our 40 or so real estate investment trust and property trusts, they make up around 10% of our total market capitalization, and they also make up around 20% of our day-to-day turnover. And our REIT market has been with us for over 20 years now, and 20 years and 5 months. And the development has been super strong. So we really, it took us maybe 4 or 5 years to really develop a critical mass, which enabled us to have this regional branding. And that was that 2006 watershed year. And then since then, over the last, let's say, 5 to 10 years, we've really accelerated the participation of the market from a global perspective in terms of issuers as well as investors. And that's seen us really develop this global hub, this global REIT hub, which at the moment still has and still offers competitive yields, averaging around 6% for the 40 or so REITs, which is still offering a premium, albeit a more marginal premium, to the global treasury rates, with the advanced economies, or the majority of the advanced economies, lifting interest rates. And I guess next is manufacturing and industrials. That's super important. So manufacturing makes up around 20 to 25% of Singapore's economy, and on a day-to-day basis, our manufacturing stocks also contribute around 20% of our day-to-day turnover. And just like Singapore's industrial production is broken down and measured and gauged by these 6 core clusters of manufacturing, such as electronics, petrochemicals, biopharmaceuticals, consumer goods, food and beverage, and so forth, we have a wide range of sectors represented by this manufacturing sub-theme, if you will. So that's a pretty important aspect of our market as well. One thing we don't have in terms of huge representation in the STI is actually technology. And that's been to our advantage this year, obviously, because the technology sector has been basically impacted by the inflationary and supply chain pressures going into 2022, and then the decline in consumer growth across the world, in particular China, and also US trade policy on technology has really weighed this sector this year. And that has been one reason why the FTSE Developed Index has been driven down to these lows of, or a decline of 25% in the year to date, versus, of course, the STI, which has maintained itself with a flat return. And we had that one stock which has a technology overlay in the STI, Venture Corporation. So as I said, globally, tech stocks are around 20% of big benchmarks like the FTSE Developed Index. But in Singapore, it's just the one stock which is less than around 2% of the STI. But that's not to say we don't have a very vibrant, interesting technology sector. It's just more mid-cap sized rather than large cap size, which commands a posting in the STI. This volatility has been particularly strong in technology this year, but there's also, if you look at it from a perspective of, yes, we have a concentration of banks in the index, and you look at diversification in an index, the more diversified it is, the less volatility there is in theory, okay? Because the more concentrated you are to one particular sector, such as technology, the more impact that that uncertainty and that volatility of the sector has on the overall benchmark. You don't have other sectors to diffuse it per se. So if you consider that, in Singapore, as I said before, we're a very international economy. So the MAS follows a policy of exchange rated policy control, rather, or policy, since I so much say policy control, but basically attempts to move our currency through these uncertain periods of inflation by looking at our currency band to the trade weighted currencies by recentering the band or moving the slope of the band, and sometimes changing one more aspect of the band. But what has been super interesting is that on a long-term basis, the volatility is diffused because we have so much regional revenue reach in the STI. So you might be surprised that of the STI, when you take the 30 constituents and you weigh it up according to all the different contributions of each stock, 49% of the revenue of the STI as a product, as an index, as an ETF, is actually generated here in Singapore at home. And 51% is actually generated outside of Singapore. And a large part of that 51% is across Asia Pacific. And it's not just one particular country in Asia Pacific, but it's very well spread around, from China to Hong Kong to Indonesia, Malaysia, Thailand. We have a lot of regional revenue reach. And that also, in a way, people might say you're hedging your bet a little bit in terms of having too much country representation. And by having that effective international spread of exposure, you ultimately are diversifying what could happen in the index on a day-to-day basis. Indonesia's economy is going one way, China might be going the other way. That impacts what's happening to the different constituents. The gains in what's happening to Indonesia might offset the losses that are happening in China and then diffuse some of the volatility. As we said, the two biggest sectors are banks and REITs. Now, they kind of have an inverse relationship when it comes to interest rates, because higher interest rates increase the net interest income through the net interest margins of the banks, versus higher interest rates can increase the funding costs for the REITs for when they make further acquisitions and so forth. So what it happens is you have that a little bit of a diverse, very different aspect. So gains in the banks can be offsetting the losses in the REITs and vice versa. So this has this diffusing impact on volatility in the STI. So I think that's a really important part to note. We do have big moves and quite a lot of vibrancy in the market when you do break it down and peel it down to either the different sectors or the different countries that these stocks are actually exposed to in their revenues or assets. So that's one important qualification I would make, that we have this incredible diversification in the index that actually does account for much of that lesser volatility that you might see on when you're comparing it to other countries and so forth. I think for the REITs, I might just do one, if that's okay. And I'm not I'm not an advisor. I work at the exchange, so all the information I'm sharing is ancillary to our role as a market provider. So all I'm just providing you is a little bit of history. And the reason why is because, as I noted before, real estate investment trusts have celebrated 20 years of listing in Singapore this year. So let's look at the first REIT to actually list in Singapore. It's our largest real estate investment trust. And as I said, in the second half of this year, it did actually celebrate its 20-year anniversary of listing. It's now known as CapitaLand Integrated Commercial Trust. Now, for the investors, the 20-year story of investing in this real estate investment trust, it began with the Capital Mall Trust IPO. The raised it was around 200 million Singapore dollars. And if I remember right, it was at 96 Singapore cents per unit, but it was 5 times subscribed. And at the time of listing, it was then a fully retail property-focused real estate investment trust. It owned 3 shopping malls. The combined portfolio value was 900 million Singapore dollars. The following year, the REIT commenced its path of booking yield accretive acquisitions and investments. That's been an important sub-theme and a driver of the growth of our REIT sector. Now, those yield accretive acquisitions, again, were fully subscribed, and they were conducted through secondary fundraisings. So the REIT does not have to go to the bank to raise the funds to make acquisitions. It can actually tap the secondary market by issuing units to shareholders, or unit holders, I should say, in the case of REITs. Now, as I said, we had 3 more brought to the IPO, and now it took only a couple of years, so the REIT ended, or a few years. The REIT ended 2005, tripling the number of shopping malls in the portfolio to 9. Meanwhile, then in May 2004 as well, CapitaLand Commercial Trust, an office REIT listed on SGX, exclusively investing in office commercial properties. And it eventually merged with Capital Mall Trust to form CapitaLand Integrated Commercial Trust recently in November 2020. Now, that created a much larger investment vehicle that could better capitalize on the trend of mixed-use developments as well that are integrating both office and retail components. Now, today, CapitaLand Integrated Trust remains our largest REIT by market value. It's among the largest in Asia Pacific, and it has a portfolio value of 20 billion Singapore dollars. So remember, 20 years ago, it came to the market for portfolio value of just 3 properties, 900 million Sing dollars. Today, the portfolio is valued in excess of 20 billion Singapore dollars. Now, for the investor perspective, over the past 20 years, if you were involved in that IPO and you subscribed, you have generated an annual totalized return of 9.9%. So 9.9% annualized total return for that REIT over the past 20 years. So that's the story of our biggest REIT, our first REIT, and there are a number of other REITs that we'd love to share with you in future discussions and just give you some history, as well as, of course, the REITs themselves do provide outlooks and updates on their portfolio, usually on a 3-month or a 6-month basis. We actually have REITs on exchange traded funds as well, which since I've talked about just one REIT, I should talk about the fact that we have a handful of exchange traded funds that are investing in REITs, not just REITs listed in Singapore, but REITs listed across the region. And the benefit of REIT ETFs, of course, is that it's just one single counter, but it's investing in or following an index which is invested over many, many REITs. So you can have access to a multiple REITs just by pressing the button once for these ETFs. And we have a number of different ETFs, a little bit thematic too. We've got our first APAC Green ETF that listed last year. We have also seen significant investor growth in terms of AUM in these REITs in the last couple of years as well. Yeah, I think one thing more I would say about the banks and their impact in the index is we are generally also recognized that low volatility is one side of it, but we also are recognized as having high yield, comparatively high dividend yields here in Singapore. And there's plenty of reasons for that. There's the real estate investment trust, yes. There's also a number of companies that are outside the real estate investment trust that are net cash positive, and therefore we command a much higher weight in the FTSE High Dividend Index across the world than we do the parent FTSE World Index because of this, this apparent high dividend yield branding. But with the STI, right, on the STI, the indicative dividend yield at the moment is around 4.3%. Now, that's significantly higher than the FTSE Developed Index of 2.4%. Now, one reason is because, as we said, banks command a large weightage, and DBS, OCBC, and UOB, they also rank among the 10 largest weights of the FTSE Developed APAC ex-Japan Sustainable Yield Index, which has a tilt towards stocks, not so much with extreme high yields, but rather financial and operating strengths of stocks across our region. Specific emphasis is on companies with strong balance sheets and the ability to generate cash flow. So that's one key reason that bank significant concentration in our index having that impact. But the banks, while they are a big important component, they have not been our strongest part of our STI so far this year. again, in nodding our head to our regional revenue reach, if remember 49% of the STI revenue reported to Singapore, but 43% reported across APAC excluding Singapore. In the year to date, our strongest three stocks have actually been Yangzijiang Shipbuilding Holdings, Jardine Cycle Carriage, as well as Sembcorp Industries. Now, Yangzijiang Shipbuilding Holdings is based in Jiangsu, China, and the shipbuilder has reached historical highs in orders this year, while at the same time, they've benefited from the appreciation of the US dollar to the renminbi because they sell their ships in US dollars. Probably a large part of it. And that's why in their sensitivity analysis in their last annual report, they noted that if US dollar appreciates to the renminbi, it suits their business. Jardine Cycle Carriage is also an auto distributor that reports 90% of its revenue to Indonesia. And then at the same time, you have Sembcorp Industries, which does make up, I think it's 60% of its revenue is reported to here in Singapore, but you still have 40% of Sembcorp Industries reporting revenue to outside of Singapore. And Sembcorp Industries is also pursuing a significant transformation of its portfolio to green energy, renewable energy. That's a long-term structural plan that they will achieve quite significant accolades they intend to by the year 2024, 2025. Yeah, I think it would be, I think it would be a natural extension. And I think particularly as our region, Southeast Asia, really starts to bring it on. We have very strong consumer growth across the region this year, particularly in Thailand, export growth, services growth. Our reopening momentum has been significant. And if we can sustain that reopening momentum, that might open the doors for more intra-regional FDI, foreign direct investment, as well as portfolio investing. I think we achieved tremendous progress in the AEC move into 2015. Then for the next 10-year plan for 2025, we are on track in terms of inter-regional integration. But we really have an opportunity at the moment through certain sectors and certain economic pillars, such as electronics, such as electronic vehicles, and of course, digitalization super important as well, and of course, food security. So there are a number of economic themes at the moment that are really drawing attention to strengthening and fortifying our interregional supply chains. And I think by natural extension, portfolio investing should grow on the back of that as well, especially as not just the stock market itself, but also the entire investment ecosystem, which includes the very vibrant private equity, venture capital, startups and unicorns across the region that are drawing so much interest at the moment. Yeah, I think that very important that we continue to make this progress with COVID-19. Global cases still seem to be, we haven't really been able to make a significant dent below 400,000 global cases of COVID a day on a smooth basis this year. That's still this resistance level, if you will, like the 4-minute mile once was. And we need to really break through that. But as long as the severity of the COVID-19 continues to decline, as long as the vaccine efficacy is still there, then you would expect that reopening momentum to continue. So we, this is still a risk, and I do have to point that out. But as I said just before, Southeast Asia has those key sectors that are driving its momentum at the moment. And the IMF actually this month in October actually did point out that we are in Southeast Asia expected to enjoy a strong recovery into 2023, thanks to robust consumption, robust services, and robust exports. As I said, digitalization continues to press forward. And what might interest you too is that digital communication has actually taken the pole position in most of the patents that have been published over the last 3 years across Southeast Asia. And this impacts many sectors, from the demand for digital banking, which makes up a very important part of the non-interest income of the banks, to hardware and semiconductor industries of the technology sector. But that will also continue to take its cues from US trade policy, as well as global consumer growth, in particular China consumer growth. For inflationary expectations, the IMF have noted that inflation expectations do remain well anchored in Singapore, and our region is expected to continue to obviously take currency cues from the US dollar, because the US tightening cycle, and at the moment, the Fed expectations are for rates to be at reach their terminal rate of 5 to 5.25% next year, and to stay at that rate for a good 5 months or so next year, a good 5-6 months or so. So, important point to note is that tightening cycle has the potential to drive currency depreciation in this region, and that also means we can be importing more inflation. So that's a key risk. But overall, the big risks that the IMF have flagged to the economic outlook, which have been tilted to the downside for a few months now, they arise mainly from the war in Ukraine and the related sanctions, obviously. The pandemic, as you quite rightly pointed out, China's growth slowdown, very important for our region, and of course that monetary policy normalization in advanced economies. Okay, so they're the key headwinds. But as we said, tailwinds in Singapore, pretty much similar to tailwinds in Thailand, and we have to work to keep that momentum going. I've been in Singapore for a good 13 years. What I really love about Singapore is that much of the great things that I live and breathe in the economy transcend into our stock market. And as I said, I have a pretty strong economic and international derivatives broker background, and every day there's always something on the move in our stock market. We have hundreds of stocks that have pretty good, okay liquidity, and represent just about every different sector and every different industry you can think of. In terms of regional, global revenue exposure, we have so much, I think, to offer investors that can complement their portfolios that might be more regional and local facing. So when you think of, as I said, Singapore, what do you think of? Strong financial services, strong infrastructure, world-class real estate, a lot of international participation, a lot of this sort of big consumer conglomerates. A lot of all this does, as we say, resonate into our local market here. So you might be coming to Singapore not to be trading Singapore stocks, but REITs that manage Walmart in the US, or, as I said, companies that are selling Toyotas and Daihatsus in Indonesia, or companies that based in Europe, basically building massive agribusinesses, value chains across the world. There is a great deal of in this incredible strategic machine that I think we have, which we call the Singapore Exchange.